Hi everyone. In the previous video, what we went over was a method called the income statement method. And in this particular video, we are going to start looking at the balance sheet method. Typically, banks who issue credit, they use balance sheet method. Other companies use them too. In this particular case, we have a hypothetical company, JKL Inc. They have a beginning balance of accounts receivable at the beginning of the period of $250,000, and what we are told is that they also have a credit balance under allowance for $5,000. And at the end of the year, depending on the age of the accounts receivable, they have certain accounts receivable balances, and based on their historical records, they can estimate how much percentage is uncollectible. So as you see, as the uncollectible accounts receivable ages past due, the estimate is going to increase. That's natural. If somebody is past 90 days, that company or that person is less likely to pay the credit. So that's why you are going to see an increasing piece for estimated account percentage of uncollectibles. And what I did here was practically I calculated the forecasted uncollectible amount. So what you practically do is multiply the accounts receivable balance by the forecasted amount for uncollectibles. And then what's going to happen is we are going to sum these up, and at the same time we are going to sum these up as well. Now what we are seeing is at the end of the period, the accounts receivable balance needs to be $850,000. Now assuming that they haven't recorded these credit sales, what we are going to do is first of all record the credit sales. $600,000 will get us to $850,000 ending balance that we calculated here. Remember, these are the ending balances. Our beginning balance was $250,000, so we need to make an additional $600,000 of sales to get there. And we are going to record this revenue. And again, I'm assuming we haven't recorded this revenue. And the allowance for uncollectible accounts at the end of the period needs to be $15,000. So we start with $5,000. It needs to get to $15,000. In order to get there, the allowance needs to increase by $10,000. So $10,000 plus $5,000, that's going to get us to $15,000. And this $10,000 is what's called the bad debt expense. It's an expense type. It's going to reduce our retained earnings by that amount. Now, in this short video, I hope I was able to explain the balance sheet method, because that's another method that you are going to see and is being used by different companies, specifically financial institutions.